Want to know if your first property investment is as profitable as can be? Well, make sure you watch this video because I'm going to be going through exactly how I analyze my property investments. I've done over 200 property deals, amounting to £35 million worth of property, and today I'm going to teach you the exact method I use to analyze my property investments. Now, to get started, it's important to understand there's many ways you can approach this, many tools out there you can use. For me personally, I use a tool called Property Engine that allows me to get a lot more data to find out whether my investments are going to be profitable or not. It's also going to give me access to a lot more granular filters so I can make sure I really narrow down my search and I'm not looking at too many properties all at once. So if we jump on the laptop here, what I'm going to do first of all is I'm going to look at what area I'm interested in. Now, my recommendation, without going into full detail about what area you should invest in, I would always look to start somewhere close to you, typically a larger city. I personally invest in Leeds, so for this example, I'm going to use Leeds as a baseline, and I'm going to put this into a search, so I've now already narrowed my search down. Now, next up, we're then going to have, in this instance, over 2,500 results, so I really need to narrow this down, and not every property deal is made the same. So first of all, we want to look at what types of properties we want to find. Things like how many bedrooms are we after? The sweet spot for me is between 2 and 4 bedrooms. It's usually where I can get the most rental income, and I make sure I'm not getting into territory where I'm investing in a very, very big house. I'm not looking to live there, so I want to make sure that I stay within a range where I know there's going to be a rental demand, which is typically 2 to 4 bedroom houses. So I'm going to put this in here. Secondly, I'm going to narrow down my property type. Now, there's lots of different properties you can invest in. My rule of thumb is I'll always invest in freehold houses and not flats. The reason why I tend to stick to freehold is what that essentially means is I fully own the house and the land upon which that house sits. If I were to buy a flat or a leasehold property, what that means is I'm beholden to a landowner. So that typically comes with sometimes expensive ground rent, service charges, aka fees that I've got to pay to the person owning the land. So that can really eat into my investment returns. Therefore, I find it a lot easier to invest in houses. It's a lot more unrestricted as well. If I want to do work to that house, if I want to build extensions, if I want to add some value to that house, then I don't have any restrictions with a freehold house, but I might need to ask for permission if I'm going for a leasehold house. So in my example here, what I'm going to do is I'm going to make sure just to include houses. I'm not interested in looking at bungalows, flats, apartments, or land. I could narrow this down even further to say, what property types am I after? You know, do I want detached houses? Do I want semi-detached? Do I want terraced houses? I find the best investments tends to be semi-detached and terraced houses. So for this example, we're going to use these two. And our next important metric here is the asking price. Now, there isn't really a right or wrong answer here because this entirely depends on the area you're in. What I want you to do is imagine your area that you know like the back of your own hand. Maybe it's where you live. So I've lived in Leeds for a long time. Now, how I assess things is on a scale of 1 to 10, how good or how bad is the area? A 1 being an absolute worst area of my city and a 10 being the absolute best. And my sweet spot is always between 2 and 5. So in other words, I don't want the absolute worst areas where I'm going to have loads of issues, but I also don't want to invest in these areas that's really expensive, that's more residential, and quite frankly, I'm not going to have the rental demand I want. So for Leeds specifically, I'm looking between 100,000 and a 200,000 range. So that's my rough 2 to 5 scale as far as Leeds is concerned. Now, a good way to check this for yourself if you're in a different area is check these areas that people tend to gravitate towards living, you know, the ones that are really, really nice upstate. Find out what the prices are in that area and then work your way backwards to find your prime investment areas. Where is there a lot of rental demand? You know, if you're in doubt, a really good point of call is speak to local letting agents, speak to local estate agents. Have them help you understand what are the areas where you see the most rental demand, where it's the best to buy for your investments. So I've got my asking price in here, I've got my number of bedrooms, I've got my property type narrowed down as well. I could get really specific here and just make sure that I definitely only include freehold. I could also determine whether or not I want to look at auction. My recommendation is if you're new to the property game to not include auctions. Auctions are usually very cheap properties, but also often properties that require a lot of work. If you are coming into the first time, This can be quite risky at times to do. You have to essentially complete on that property in 28 days. So for my search here and for this example, we're going to exclude that for now. And we can see we still have 234 potential properties to look at here. Now there's a lot more filters I could add to this, but we'll leave it there for now. So let's try and have a look into this. So we've narrowed down the criteria now. So we've now got the 234 different properties to look at. Now something I want to be mindful of here is I'm going to have to stick to a budget. So I know roughly how much I've got to spend here, which is going to fit within that price range I've set as well. So if we take the first property we've got here, for example, so we can click on this and we can get a few details around the properties. It's a 3-bedroom terraced house, asking price £185,000. And we've got a bit of a description of the property here so we can get a little bit of an understanding of what the property is. This is what the estate agents will have written down as a description. What we can also do is we can check the floor plan so we can see what we're actually working with in terms of the space of the property. So a 3-bedroom house, we can see there's some pretty decent sized bedrooms here, which we like. This is something to be mindful of as well. Even though it says it's a 3-bedroom house, you could end up with having one bedroom that's really, really small. And the reason it's really important to think about as well is who is that tenant going to be that's ultimately going to live in the property? You know, are they going to have the space they need there to live in that property for a long time, which is what we want. Now, perhaps the most important thing to look at here is, am I going to pay too much for this property and what are my returns going to be? So the first thing I'm going to do is I'm going to start analyzing the numbers here. I want to have a quick look at the condition of the property. So I'm just going to have a quick scan through the photos, and in all fairness, a little bit tired, a little bit older, so I know I probably need to spend a little bit of money on the refurb in this particular situation, which is not a problem, but of course we need to factor this into our costs. Now, knowing the rough condition this is in, I want to go and have a look at my comparables. So I'm going to click in here. Now you can see this actually pre-selects the same property type. It will pre-select the same number of bedrooms, and it will also set a couple of other filters on that I would always recommend you use. So we want to make sure that whatever we're comparing the property to has been sold recently, typically within the last 12 months. We'll want to make sure it's the same number of bedrooms. We'll want to make sure it's the same property type. The reason we're doing that is a terraced house is going to be cheaper than a semi-detached house. So we want to compare apples to apples. We don't want to compare a 2-bed house to a 3-bedroom house. And we want to make sure that the data we get are recent. Now, what we can then see is we can see a couple of comparables nearby. Really important here as well, we're trying not to go too far afield. So I'm using 1/4 mile radius, which is a good starting point. So we know we're not comparing to properties across the town. We want to compare to properties that are nearby that have sold recently. So looking through this, we can see there's a comparable nearby here. We can see that was, scrolling down here, that was sold for $200,000 in April 2025. So if I quickly scan through the photos and see this is a very nicely done up property, certainly compared to the one we're looking at here. So that's already going to give me a bit of a baseline to compare to. So I'm looking at property here. You can see the numbers on the left-hand side of the screen. $185,000 asking price. And I'm looking at something here that's sold, completely done up, really nice condition for about 200. So I'm already starting to get a bit of an indication of whether or not I might be overpaying for a property like this. I've got another one here at 160. Again, really nice condition, but also looks a bit smaller. By actually looking at the total floor area, you can see 89 square meters in the property we're looking at, and then we've got 84 in this one. So very similar, good condition. And already there's some discrepancy. So we're now going from 200 down to 160. So at this point, you typically want to find a bit more data. The more data points you're going to have for your comparables, the more accurate assessment you can make on whether or not you're paying too much for that property. So we've got a third one here. So this was, you scroll down here, that was sold for 170,000. So we're somewhere in the middle there. And this seems to need a fair bit of work as well. Certainly judging by the pictures there. So we've got 3 fairly decent comparables there to look at. We could go a bit further afield, having a look over here. But now we're starting to get into properties that look quite different. So compared to these properties, which are these terraced houses, they're a lot smaller. We're dealing with a quite significant different type of property here. I suspect looking at the photos here, we've probably got some kind of garden or backspace here. So it's a quite different property that isn't really going to be suitable, comparable for us. Now, a lot of this is going to come down to a bit of a gut feeling. We want to compare apples for apples, so you want to make sure that you look at similar properties. They need to be as identical as you can possibly find them. In this instance, we've got 3 comparables to look at here. In my estimate, already looking at this, knowing that there's one property here that sold for 200, completely finished up. There's another one at 160 in very good condition as well. My instinct would be that this is quite expensive for a property, right? 185,000 for something that will need some work done to it, and I'm probably going to end up overpaying for that property. At the same time, the other thing I want to make sure I check is the rental figures. So whilst my purchase price might not be right, I want to make sure that my rent is going to add up to what I need it to be. So I'm going to go back to the comparables here. I'm going to go to let agreed, so properties that have already had a tenant agreed to move into that property. And I want to see what properties can actually get here. So I've got a couple of comparables down the street. Start with one here. So this is rented out for £1,150. I can see it's a 3-bedroom house again, making sure it's the same type of house. It's in okay condition, not the best. 1,150. And another one, same price, fairly decent condition as well. So quite quickly here, I'm starting to get a bit of an idea of where I'm going to be with my rental figures as well. And it's looking like it's somewhere in the region of maybe about £1,000 to £1,100. Then we've got a little bit of a curveball here, 950 for a done-up property. So I know my figures are somewhere in between there. So if I wanted to be on the safe side, I might say £1,000 on this. Now, how do we actually work out the numbers here? Now, let's say I really struggle to find any comparables, any suitable comparables. I think I've been quite lucky here. There's some good examples to take from here. I want to either widen my search. The ways I might do that is I could also look at what properties are currently for sale, right? So my hierarchy, as it were, is I would always look at properties that have sold first. I'm then going to look at properties that are under offer, aka properties that have had an offer accepted on them. So that'll be my next best guesstimate to the price. And failing that, I will look at properties that are currently on the market besides the one I'm looking at. So all of this that we're trying to do is an amalgamation of information. The more data points I have, the more information I have, the more accurate an assessment I can make. You might run into a scenario as well where you just don't have any comparables. In that instance, my recommendation is go a bit further afield. So I'm looking quarter mile, you might want to go to half a mile. You may want to look at, not just terraced houses, you might want to look at semi-detached houses as well. When you do, take that with a grain of salt. As we know, semi-detached houses are a little bit more expensive than terraced houses. If we're comparing 3 bedrooms to 2 bedrooms, if we absolutely have to, we want to keep in mind that the 3 bedrooms are going to be more valuable than 2 beds. Most of the times, if you're in the big cities, you won't struggle to find your comparables. There'll be plenty there for you to tap into. My last point of call is always to go to the local estate agents. So if I can't find an accurate assessment, I will contact multiple estate agents and I'll try and get their opinion on what they think the property is worth. Is it overpriced? Is it the correct price? Is it underpriced? The more agents I ask, the more information I'm going to be able to use. Now, before we dive into the actual calculation, we're going to try some things with the numbers here in a second. I want to briefly just mention as well, if you're uncertain about an area, another tool I use is Street Check and also Google Maps. If you're not local to the area, if you don't know the area, this is a really good way of just, checking that you're investing in an area that's actually decent. So what Street Check will give you is it'll give you an overview of the demographics of an area, things like crime, the makeup of how many people own houses versus how many people rent. So this can give us a lot of good macroeconomic information, not down to the numbers, but just to see whether we might be investing in a good area or not. So to do that, we just need the postcode. So if we go back for a second here, we've got the postcode. I'm just going to copy that. And I'm going to search for that. And straight away, you can see I've got a combination of area information. I can see the breakdown of housing, so I can see the ratio of the different property types, terrace, semi-detached, detached houses. I can see the tenure, so I can see how many are rented from the council, how many are owned outright, how many are owned but with a mortgage, how many people are living in the property, things like crime, employment, the culture, the ratio of gender, right? So this is giving me a lot of data, probably more than I need in all fairness. My last check I would normally do is also checking Google Maps. So really just getting a feel for the street, and I like using Street View. So I'll go to Google Maps, I'll put my postcode in, and I'll just have a quick check at a street level, have a quick scan around, a little bit of graffiti, so it might be a little bit of a rough area, right? But it's starting to give me an idea of where I'm actually going to invest. Now we want to keep this investment for a long time, so we want to make sure we pick the right areas. So if we go back to our property that we're looking at here, so it's seeming like we might be paying a little bit more for this property, but let's try and find out how much we could pay for it. So in order to do that, what we're going to do is we're going to jump over to a calculator, we're going to put some of these numbers in, and we're going to see how that looks. So what I've got here is I've got a detailed calculator where we can now start inputting some of these numbers and actually give it an idea of how much we're going to make on this property. So we know the current asking price right now is 185,000, right? We know we need to add some extra fees in. So the buying cost section here that I'm using is just to factor in those extra fees we might have. Things like your solicitors. You need to remember we need to pay the solicitors to do the legal work to the property. So I usually factor in £1,500. We might have to pay a mortgage broker if we're looking to buy this with a mortgage. So I would factor in £750 for that. Now, in this instance, this is automatically going to calculate the stamp duty tax we have to pay as well. If you're not sure about this, there's plenty of calculators you can find online to make sure that you're getting that right figure for how much you need to pay on your stamp duty. If there are any other costs we might need to factor in, we could input them here, but we don't have any for now. I'm then going to choose how I want to buy the property. Now, I want to buy my properties with a mortgage, so I'm going to keep this at a 25% deposit. I know the interest rates I can get right now is around 5%, so this is what we'll use for the example. We've then got the refurb cost, and this is almost a skill in of itself. Now, we saw that property we're looking at right now requires a little bit of work. And ultimately, if you haven't done refurbs before, this can be a really hard thing to assess. What I did when I started, when I didn't have any property experience, was I worked with local builders. I took builders out to the properties with me, and I would get price lists from the builders on how much it would cost them to do certain refurbs. And I'd almost create like a little bit of a list for myself of what different items cost. So how much is a new kitchen going to cost? How much is a new bathroom going to cost? How much is it going to cost to redecorate a room? And if you do this with a couple of builders, you'll have some prices to compare to. It'll be a lot easier for you to just look at photos of a property and then assess a rough refurbishment cost based on that. Now, we can always renegotiate if something comes up later, but it's really good practice for you as a property investor to make sure that you have a basic understanding of refurb costs. Now, I've been doing this long enough that I have a rough idea of how much everything costs. So in this instance, I would estimate this is probably going to cost us in the region of about 15,000 to put this up, get a bit of decoration and make the property look a little bit nicer again. I've then got my holding costs. So I've got costs associated on a monthly basis with actually keeping the property. Now I have my building insurance. So it's really important to make sure that you get landlord insurance on your property. The reason you want this is to protect you in case there's something that's going to happen with that property. So if you were to have a flood, if you were to have a fire in your property, if you had a burst pipe, if you had some kind of significant issue in the property, the insurance is going to cover you. If someone broke into the house, you're also covered. So definitely make sure you pay for your insurance. I factor in about £25 a month for this, but this can vary. Good practice to speak to an insurance broker to see what you can get. Now, the rental income I want to put in, and then I'm going to get some other figures derived from this. So we saw the rental income was somewhere between £950 to £1,100. So in my instance here, I'll use £1,050. And we can see above here, it's already calculated my management costs. So this is what I have to pay to the letting agent to basically manage the property for me. Typically, that should be about 10% plus VAT in a buy-to-let property. Now, I've also factored in 5% of other costs. What we have to keep in mind is you might have some regular repairs, you might have a bit of maintenance that you need to do to your property, or indeed you might have a tenant that moves out for a period of time, and then that's a month where you might not get any rent paid. So good rule of thumb I use is I'll just use 5% to kind of cover myself, so I know I've got to set a little bit of money aside for those eventualities. I'm not going to have any council tax or utilities to pay. This is all paid on the tenant side. So I can see some numbers from this already. Now I can see my gross yield figure, 6.81%. Now what does that mean? So gross yield is simply just a figure where we're taking the purchase price and we're just dividing it by the annual income of the property without factoring in any of our costs. So some people prefer using yield. I find it's a bit of a disingenuous figure to use, and it's not really going to give you a clear picture of how good of an investment this might be for you because it's not factoring in the cost. The better figure I go for is ROCE, return on capital employed. Now, quite simply, this is a metric I can use to measure how hard my money is working for me. And this goes for any investment type, right? So by using this figure, I could compare property investment to stocks and shares. I could compare it to investing in the bank. I could compare it to investing in crypto. So it's a much more accurate figure because it's going to factor in all my costs as well as my income from the property itself. So what I can see here is I need to purchase this property 73,950. So this is going to be a combination of my deposit, which is 46,250, my costs. So this is my refurb, this is my stamp duty, my legal fees, which is 27,700. So this is my total investment needed. I can also see that my net cash flow after I paid the mortgage is £268, right? So there's a significant reduction there because I obviously have to pay my mortgage at 5% that we put over here. And I can see my monthly mortgage in this situation is about £580. So what that then gives me is that gives me a ROCE on an annual basis of 4.35%. So what that means is for that £74,000 that I've put in, I am making a 4.35% return on that money, which is better than most banks, but maybe not quite where we want to be with a property investment. What we also have to factor in is properties are going to go up in value over time. So property prices double on average every 10 years. So we need to factor this into our returns as well. Now, what I've done here is I'm assuming a rate of growth of 4%. So I'm basically assuming the properties are going to go up 4% every year, which is a bit on the low side depending on what city you're in. What this then tells me is based on that 4%, I'm actually making 10% return. So the £185,000 property is going to go up 4% every year, and that means I have a 10% return on that. If I combine that with my first figure, which is my income, my cash flow, my combined return is actually 14.36%. So now we're starting to get somewhere. Now, of course, we want to make sure that we get the absolute best investment. And as we saw when we looked at the comparables, the price maybe was a little bit on the higher side. So we might be in a position, we go back to the agent, we try and renegotiate a little bit, see if we can get a lower offer put in. Now, a good tactic I was always taught is when you put an offer forward, you want to make sure they say no the first time around, which sounds a bit backwards, right? But if someone says no to your offer, it means that, you can negotiate from there. If they said yes straight away, it probably means I've offered too much for the property. So I always make sure that I go in a little bit lower to start with. And then if they say no, that's a great starting point to start negotiating on the property. Let's say I do put an offer in on property and I manage to get this 170,000, which is not massively far away from the price they were asking in this. We can see actually it doesn't affect my figures that much. What we have to keep in mind though is my total cash that I need to buy the property is also a lot less. So even though my return is not that affected, it does mean I'm going to earn a little bit more per month, and it means that the investment I need is going to be a bit less than what it was before. So it's always worth building in a a little bit of a discount if we can. The other thing I will always keep in mind is whatever you think the refurbishment cost is going to be, make sure you add a contingency on top. Things rarely go to plan. You often find there's going to be hidden costs, there's going to be things you hadn't foreseen. I use a buffer of about 10 to 20% to make sure I've covered my backside, just in case that refurb turns out to be a little bit higher than I maybe thought it was going to be. Now, if you're looking at a property that needs a little bit more work, it's really important to factor in your running costs as well. You're going to have some bills, you're going to have some costs going out whilst you're refurbing that property. So it's really important to make sure you understand how long is the project going to take and how much of those costs going to be on a monthly basis. Now, this is something that can really run away from a lot of people when they first start. When I started out, I stuck with things that required no more than about £8,000 worth of refurbishment. These days, I'll take on much bigger projects than that, but I think it's a good rule of thumb to start with smaller refurbs as you're beginning your journey, and as you're getting used to that process, you can start finding bigger projects that need more refurbishment. So we looked at a bit of an example there. One of the mistakes I see a lot of people make is they get very fixated on the asking price of a property. The reality is you're going to find a lot of properties that are on the market that are actually priced very, very well. And it's a common mistake I see especially beginners make where they always want a discount on the asking price, right? You need to stick to the data. This is why it's really important that we go through the comparables and we see, are we actually overpaying for that property or not? Because you might not be. Now, in this particular example, what we saw is this property looks like it's probably overpriced a little bit compared to where we want it to be. That's not always going to be the case. So it's really important to make sure you do your research, run through the comparables, check the data, see what properties have sold in the area. Because you might not be overpaying for that property. You might get a bargain of the century, but you won't know until you do the research and follow those steps. That's going to give you an accurate assessment of whether this is going to be a good investment for you or not. The rest comes down to personal choice. How much money are you looking to make from your investment? And that's something only you can answer. Everyone's going to have different requirements. Some people are going to be happy with making £300 net a month. Some of you might want to make 500. Now, whatever the case, your requirements is going to be entirely unique to you. You might be looking at making £200 a month and you're happy with that. You might be okay making less than that, 150, or you might want to make £500 a month. It's really important to start with the end in mind often. So see how much you're looking to make from this property. And as you're doing the research, as you're inputting numbers, you'll be able to see if it hits the target that you're looking for your first property investment. So we've seen the process there, how to analyze your first property investment. And you'll hopefully be able to see how important it is to run the numbers to actually see whether we're getting a good investment or not. Don't make the mistake of skipping out on the research. This is what can really save you from a truly bad investment or getting the investment of a century. Now, if this video has been helpful to you, make sure you subscribe and hit the like button for more content like this in the future.